Welcome to this lecture on Renko Charts, a unique price-based charting technique originating from Japan designed to filter out minor market fluctuations. Unlike time-based charts such as candlesticks, Renko charts only change when the price moves by a predefined amount, known as the brick size. The name Renko derives from the Japanese word renga, meaning brick, reflecting their construction from stacked bricks that represent fixed price movements. This design makes Renko charts particularly effective for highlighting trends, support, resistance, and breakouts by removing the noise of intraday volatility. To construct a Renko chart, you first choose a brick size, typically a fixed dollar amount or percentage. An upward brick is added each time the price rises by at least one brick size above the previous brick's top. Conversely, a downward brick is added each time the price falls by at least one brick size below the previous brick's bottom. Crucially, Renko charts ignore time. Several days may pass between brick formations if the price does not move enough. This construction produces a sequence of bricks that move up or down at 45-degree angles, smoothing out minor oscillations. For example, a Renko chart for SPY daily prices might use a fixed brick size equal to approximately 1% of the median price. Each green brick represents a 1% upward move, and each red brick a 1% downward move, effectively visualizing the underlying trend. While fixed brick sizes are common, dynamic brick sizing using the average true range, or ATR, adapts to changing market volatility. This approach allows larger bricks during volatile periods, reducing false signals, and smaller bricks in quieter markets, capturing subtler trends. In practical interpretation, consecutive emerald green bricks indicate an uptrend, while consecutive crimson red bricks signal a downtrend. A color change, for instance, from green to red, often suggests a potential reversal in market direction. New bricks extending beyond recent highs or lows often confirm breakouts, signaling significant price movements. Conversely, two or more opposite-colored bricks can indicate trend exhaustion, suggesting a weakening of the current trend. Horizontal clusters of brick tops or bottoms create clear support and resistance zones, which are easily visible in Renko format. Compared to candlestick charts, Renko charts ignore time and intraday volatility, focusing purely on directional price movement. Unlike Heikin-Ashi charts, which average out candles mathematically but remain time-based, Renko charts are unique in strictly filtering out moves smaller than a chosen threshold. This makes trends more visually evident and easier to identify for traders. Renko charts embody the behavioral principle that clarity changes perception, allowing traders to perceive trends more confidently. Among their strengths, Renko charts remove noise and highlight true trends, simplifying visual analysis and trend confirmation. They also work well for trailing stop strategies, providing clear visual cues for managing risk. However, Renko charts do have weaknesses, such as lagging price due to their confirmation requirement. The selection of brick size is subjective and crucial to reliability, as an inappropriate size can lead to unreliable signals. Furthermore, Renko charts ignore volume and time, which can limit contextual understanding of market dynamics. In conclusion, Renko charts are a powerful tool for trend identification and trading decisions, best used alongside other indicators to overcome their inherent limitations. Thank you for watching our lecture video on financial technical analysis focusing on Renko charts. See you at the next lecture.